I want you to look at the monetary system the way I have learned to look at every large system in the world. Do not look first at the headlines. Look at the plumbing. Look at the incentives. Look at who needs what, who is paying whom, who is holding whose paper, and what happens when the people who used to trust the system begin to reduce their dependence on it. Because when a monetary system changes, it rarely announces itself in one clean sentence. It does not ring a bell. It does not appear as one dramatic event where everyone agrees that the old era has ended and the new era has begun. It changes through flows. It changes through small decisions made by powerful players. One country prices a little more trade outside the dollar. One central bank buys more gold than it used to. One oil producer wants more freedom from an old cartel. One government holds fewer treasury bonds. One payment system begins to operate outside the old network. At first, most people dismiss these things as isolated events. Then, years later, they look back and say the world order changed. I do not think that is the right way to understand it. The world order is not changing later. It is changing in front of us now. One of America's important partners in the energy world has moved away from the organization that helped manage oil production for decades. At the same time, some of the major oil producers are openly exploring whether oil must always be sold in dollars. And while most ordinary investors are still looking at the same stocks, the same indexes, and the same old assumptions, the central banks of the world have been buying gold at a pace that tells you something very important. When the people who create money are choosing to own more of something they cannot create, you should pay attention. That does not mean the dollar disappears tomorrow. That does not mean the American system collapses next week. That does not mean you should panic, sell everything, and hide in a basement. But it does mean that the system that made the dollar uniquely powerful for the last half-century is developing cracks. And if you understand those cracks early, you can protect yourself better than the person who waits until the mainstream media finally explains the story after the price has already moved. The framework is simple. First, you need to understand what the petrodollar system actually is, not the cartoon version, not the conspiracy version, but the actual economic machine. Second, you need to identify the specific fractures that are weakening that machine right now. Third, you need to look at where the largest, most informed institutions in the world are putting their reserves, because their behavior often tells you more than their speeches. That is how I think about this. I do not begin with ideology. I begin with the machine. The petrodollar system was one of the most important economic arrangements of the modern era. It was not just about oil. It was about money, power, military protection, government borrowing, and the role of the dollar as the central bloodline of global trade. After the oil shock of the 1970s, the United States needed to stabilize the energy system, and the oil producers needed security and a reliable financial relationship. Out of that period came an arrangement that shaped the world. The first pillar was that oil would be priced in dollars. This mattered more than most people understand. Oil is not a small commodity. It is the commodity that powers transportation, factories, agriculture, shipping, heating, plastics, chemicals, and the movement of goods across the world. If almost every country needs oil, and oil is priced in dollars, then almost every country needs dollars. That creates a constant structural demand for the U.S. currency. It means that a country in Asia, Europe, Africa, or South America that wants to secure energy must first secure dollars. It must hold dollar reserves. It must participate in the dollar system. That is an enormous advantage. The second pillar was that the dollars earned by oil exporters would come back into the U.S. financial system. Saudi Arabia and other oil producers would sell oil, receive dollars, and then recycle a large part of those dollars into U.S. Treasury bonds and other dollar assets. That helped the United States borrow at lower interest rates than it otherwise could have. It meant there was always deep foreign demand for U.S. debt. That gave the United States what economists sometimes call an exorbitant privilege. It could run larger deficits, it could import more than it exported, it could borrow in its own currency, it could print the currency that much of the world needed to settle trade. That is a remarkable position to be in. The third pillar was security. The United States provided military protection, weapons, political support, and stability guarantees to the Gulf monarchies. The energy exporters received protection. The United States received dollar-based oil trade and recycled oil revenue. That was the machine. Oil created demand for dollars. Oil dollars came back into U.S. debt. U.S. military power protected the oil system. The system reinforced itself for decades. Once you understand that, you also understand why any weakening of that system matters. It is not just about whether one oil contract is priced in another currency. It is about whether the automatic demand for dollars begins to become less automatic. It is about whether oil money still returns to U.S. Treasury bonds with the same force. It is about whether countries still see dollar reserves as a neutral store of value, or whether they increasingly see them as assets that can be frozen, sanctioned, diluted, or politically controlled. And that brings us to the first major crack. Some energy producers want more freedom. In a cartel or a production agreement, the members do not always have the same incentives. One country may want to keep supply limited to support price. Another country may have invested heavily to produce more and may not want to keep its output capped. When the country with growing capacity feels constrained by the old system, it begins to seek more independence. That is what matters about the UAE story. The important point is not only the political headline, the important point is the incentive. If a country has built the capacity to produce more oil and gas, but the old framework limits how much it can sell, then that country begins to ask a very rational question. Why should I remain inside a system that limits my ability to monetize what I have built? In markets, incentives are stronger than speeches. A producer that wants to sell more will eventually push against any structure that tells it to sell less. And the moment a major oil producer begins thinking more independently, the old system becomes less stable. That is the first crack. The second crack is that the buyer base has changed. China is a major customer for Gulf energy. India is a major customer. Emerging markets are growing. Trade patterns are changing. Energy demand is increasingly tied to countries that do not want to rely entirely on the dollar system. If your biggest customer is China, it becomes natural to ask whether some long-term energy contracts should be settled in renminbi, or whether at least some portion of trade should move outside the dollar. This does not require the dollar to be replaced completely. That is a mistake many people make when they think about reserve currencies. They imagine a sudden binary event. One day the dollar is dominant, the next day the dollar is dead. That is not how systems usually change. Systems change at the margin first. A few contracts settle differently, a few countries hold more gold and fewer dollars. A few payment systems grow around the old rails. A few reserve managers diversify quietly over time. The compounding effect becomes large. That is why I do not ask, will the dollar disappear? I ask, is the marginal demand for dollars weakening? That is the more useful question. Because if oil sellers begin accepting more currencies, if large buyers increasingly settle in local currencies, if BRICS nations build payment alternatives, if India pays for oil in rupees, if China negotiates long-term energy deals in its own currency, then the monopoly is no longer absolute. A monopoly does not need to be destroyed to become less profitable. It only needs to become less complete. That is what is happening to the dollar system. It is not going to zero. It is losing some of its uncontested position, and that matters a great deal. The third crack is the recycling mechanism. Remember the second pillar of the petrodollar system. Oil dollars came back into U.S. debt. That recycling helped the U.S. government finance deficits. It supported demand for treasuries. It allowed the United States to borrow at more favorable rates than it otherwise might have. But some of the largest foreign holders of U.S. debt have been reducing their exposure. China has cut its treasury holdings substantially over time. Some allies have increased holdings, so this is not a universal stampede. It is not a simple story where everyone is dumping dollars at once. The world is more complicated than that. But the direction of behavior matters. If some major powers are less willing to hold us debt, and if the United States is simultaneously running very large deficits, then the funding burden must be absorbed elsewhere. Either domestic buyers absorb it, or allies absorb it, or the Federal Reserve eventually becomes more involved. Or interest rates rise enough to attract buyers. Each path has consequences. This is why reserve management is one of the most important subjects in the world, even though most people find it boring. The question is not just what countries say. The question is what they hold. What they hold reveals what risks they are trying to reduce. And since Russia's foreign currency reserves were frozen by the West, central banks around the world have received a powerful lesson in counterparty risk. If your reserves are held in another country's currency inside another country's financial system, then those reserves are not purely yours in a crisis. They are yours as long as the political system that controls the rails allows you to access them. That realization changes behavior. It makes gold more attractive. Gold has no central issuer. Gold is not someone else's liability. Gold cannot be printed by a central bank. Gold does not require permission from a payment network. Gold does not default. Gold does not have a board of directors. Gold does not promise you anything. It simply exists. That is why central banks buy it when trust declines. They are not buying gold because they enjoy shiny metal. They are buying it because it sits outside the liability chain in a world where the liability chain becomes more politicized. The asset that has no counterparty becomes more valuable. That is the institutional logic. And when you see central banks buying gold at very high levels, you should not dismiss it as old-fashioned thinking. Central bankers understand the system. They operate inside the system. If they are diversifying away from claims on other governments and toward an asset that cannot be frozen as easily, that is a signal. I call it a behavior signal. Words are cheap, reserve allocation is not. Now, this is where the investor must be careful. The point is not to become emotional. The point is not to say the dollar is finished. The point is not to say gold is the only thing you should own. The point is to understand why gold has been responding the way it has been responding. Gold is not just reacting to one war, one headline, or one inflation print. Gold is reacting to a structural shift. I think of the gold thesis through 3D. The first is de-dollarization. Again, de-dollarization does not mean the dollar disappears. It means that some countries, some central banks, and some energy producers want to reduce their dependence on the dollar system. That can happen through local currency settlement. It can happen through BRICS payment systems. It can happen through bilateral trade agreements. It can happen through central banks holding more gold and fewer treasuries. It can happen gradually, but gradual changes in a very large system can produce very large investment effects. The second D is debasement. The United States is running large fiscal deficits. The debt burden continues to grow. When governments borrow more and more, and when political systems are unable to resolve the imbalance through taxes, spending cuts, or productivity alone, the pressure often shifts toward currency debasement. That means the nominal debt remains, but the value of the currency declines over time. Debasement is not always dramatic. It can be slow, it can be polite, it can be hidden inside inflation, low real rates, and central bank balance sheets. But the effect is the same. Each unit of currency buys less. If dollars can be created in unlimited quantities and gold cannot, then over long periods of excessive money creation, gold tends to preserve relative value better than cash. That does not mean gold rises in a straight line. Nothing does. It means that gold functions as a hedge against the repeated temptation of governments to solve debt problems by reducing the real value of the money. The third D is diversification. In a world of rising geopolitical fragmentation, concentration risk becomes dangerous. If one country holds all its reserves in the currency of another country, it has concentrated risk. If one investor holds all his assets in one financial system, one currency, one market, or one policy regime, he has concentrated risk. Diversification is not about predicting disaster. Diversification is about acknowledging that you cannot predict perfectly. When Europe rearms, when the Middle East becomes more unstable, when energy trade shifts, when payment rails become political tools, when the US and China compete across trade, technology, finance, and security, it is rational for institutions to hold assets that are not dependent on one government's promise. Gold fits that role. That is why the 3D framework matters. De-dollarization explains the shift away from automatic dollar dependence. Debasement explains the desire to hold something that cannot be printed. Diversification explains why institutions want assets outside the political and financial liability chain. Together, they create the structural case. Now, how does a regular investor think about this without doing something foolish? First, you must separate thesis from position size. A thesis can be right and still hurt you if you size it badly. I have seen people be directionally right about a big macro shift and still lose money because they used leverage, concentrated too much, bought after an emotional spike, or had no risk controls. The goal is not to be dramatic. The goal is to be resilient. If you believe gold has a role, there are several ways people express that view. One is physical gold. Physical gold has the advantage of being outside the financial system if held properly. It has no counterparty in the same way a bank deposit or brokerage claim does. But it has practical problems. You must store it, insure it, protect it, and handle liquidity. It is not as simple as people make it sound. Another way is a gold ETF. That is easier for many investors because it can be bought and sold like a security. You do not need to store bars. Think about physical security or deal with spreads from coin dealers, but it is inside the financial system, which means it has a different risk profile. It gives exposure to price, not the same type of sovereign personal control as physical metal. Then there are gold miners. Miners are not gold. They are businesses. That is very important. A gold miner can be a leveraged play on the gold price because if gold rises and the miner's costs do not rise as fast, the miner's margins can expand significantly. But miners carry operating risk, management risk, jurisdiction risk, labor risk, energy cost risk, and balance sheet risk. They can outperform gold when things work. They can underperform terribly when things go wrong. So a miner is not a safe version of gold. It is a business tied to gold. If you understand that distinction, you are already ahead of many people. There are also silver miners, broader precious metals funds, and companies linked to the mining supply chain. Some may lag the metal and then catch up later. Some may never catch up because the business is not good. That is why you cannot just buy a name because it has the word gold or silver attached to it. You have to look at the actual economics. What are the reserves? What are the costs? Where are the mines? How much debt is there? How much dilution is happening? How good is the management? What happens if the metal price falls 20%? This is how a principled investor thinks. You do not fall in love with the story. You test the machine. The big picture is that the dollar remains extremely important. The United States still has the deepest capital markets in the world. The United States still has the largest stock market. The United States still has enormous innovation, military power, institutional depth, and legal infrastructure. The dollar will not vanish because a few countries experiment with settlement alternatives. But the old, unchallenged monopoly is fading. That is the real point. If an investor expects the next decade to look exactly like the last 5 decades, he may be making a dangerous assumption. The world that created the petrodollar system was built around American dominance, Gulf security dependence, oil trade in dollars, and recycling into treasuries. The world developing now is more fragmented. Energy buyers are different. Payment systems are diversifying. Central banks are buying gold. Debt levels are higher. Sanctions have taught countries that reserves can be weaponized. Inflation and deficits have taught savers that currencies can be diluted. And in that kind of world, the assets that win may not be the same assets that won during the previous regime. This is how cycles work. A system becomes dominant. People extrapolate it. The dominance produces excess. The excess produces imbalance. The imbalance produces a reaction. The reaction creates a new opportunity set. Most people do not see the transition because they are emotionally attached to the old system. They confuse what has worked with what must always work. That is dangerous. The right mindset is not to abandon the old system. It is to understand how it is changing and adjust with it. If the dollar remains strong, a diversified investor can still benefit from US assets. If the dollar loses some relative strength, the same investor may benefit from gold, commodities, real assets, and non-dollar exposures. If inflation remains higher than expected, hard assets may protect purchasing power. If geopolitical fragmentation accelerates, assets without counterparty risk may become more valuable. That is not fear. That is risk management. I think most investors underestimate how much of successful investing is simply avoiding concentration in one worldview. If your entire financial life depends on the assumption that the dollar system stays exactly as it is, you are making a bet whether you admit it or not. If your entire financial life depends on the assumption that the dollar collapses immediately, you are also making a bet. The wise approach is not to make one extreme bet. The wise approach is to build a portfolio that can survive multiple outcomes. That is why I care about gold in this environment. Not because I know every future event, not because I want to predict the exact timing of a dollar decline, not because I believe central banks are omniscient, but because the behavior of central banks, oil producers, energy buyers, and governments is telling us that the world is moving from a unipolar reserve system toward a more fragmented one. In fragmented systems, neutral reserve assets gain importance. Gold is one of the oldest neutral reserve assets in human history. It has survived empires, wars, defaults, currency reforms, political revolutions, inflationary cycles, and debt restructurings. That does not make it magic, it makes it durable. And durability matters when trust begins to weaken. When I look at the current environment, I see several things happening together. Oil trade is becoming less automatically tied to the dollar. Some large foreign holders are reducing Treasury exposure. Central banks are buying gold aggressively. The U.S. debt path is creating more long-term debasement risk. The world is becoming more multipolar, and investors are still largely positioned as if the old world is perfectly stable. That is where asymmetry may exist. Asymmetry does not mean certainty. It means that the potential payoff of being prepared may be large relative to the cost of modest preparation. A small allocation to the right hedge can matter a lot when the system shifts. A disciplined position in a structural trend can compound meaningfully over years. A framework for following money flows can help you adapt instead of reacting late. The important thing is to think in layers. Do not ask only what is the best asset. Ask what role does each asset play. Cash gives optionality, but it loses value if debasement continues. Stocks give participation in productivity, but they are exposed to valuation risk. Bonds give income and stability in some environments, but they suffer when real yields are negative or inflation surprises. Gold gives protection against monetary distrust, but it does not generate cash flow. Real estate gives inflation, linked utility, and debt advantage, but it is illiquid and rate sensitive. Commodities can benefit from scarcity, but they are cyclical. No asset is perfect. The goal is to understand the environment and assign each asset a role. The petrodollar system gave the dollar a central role for 50 years. If that role becomes less dominant, then portfolios built only for the old world may be underprepared for the new one. That is the lesson, not panic, not ideology, not a simple slogan. A system is changing and investors need to watch the flows. Where is oil being priced? Where are reserves being held? Where are central banks allocating? Who is buying treasuries? Who is buying gold? Who is building alternative payment rails? Who benefits if dollar demand weakens at the margin? Who suffers if it does? These are the questions that matter. Most people will wait for a headline that says the dollar era is over. That headline will probably never arrive in that clean form. By the time the average person feels the change, the markets may already have priced much of it. That is why you need to understand the machine early. When I studied big debt cycles, reserve currency transitions, and the rise and decline of empires, I found the same pattern again and again. The dominant power builds a strong system. The strong system creates wealth. The wealth creates borrowing capacity. The borrowing capacity creates debt. The debt eventually requires monetary flexibility. The monetary flexibility reduces trust in the currency. The reduced trust causes diversification. The diversification weakens the reserve advantage. The weakening reserve advantage makes the debt problem harder, and then the cycle accelerates. That does not mean collapse is inevitable in a straight line. History is not a straight line, but the pressures are real. And when pressures are real, pretending they do not exist is not a strategy. The investor who does well is not the one who screams the loudest. It is not the one who predicts the apocalypse. It is not the one who repeats the old consensus because it feels safe. It is the one who watches cause and effect calmly. If oil trade becomes more diversified, dollar demand weakens at the margin. If dollar demand weakens, U.S. borrowing conditions become more complicated. If U.S. borrowing conditions become more complicated, the temptation for monetary debasement rises. If debasement risk rises, neutral scarce assets become more attractive. If central banks understand that, their gold buying should not surprise you. And if their gold buying does not surprise you, you are already thinking ahead of the majority. I would not build a portfolio around fear. I would build it around principles. Own assets that benefit from productivity. Own assets that can protect purchasing power. Do not depend on one currency. Do not depend on one political system. Do not depend on one debt structure. Do not overconcentrate in assets that only work if the last 50 years repeat exactly. And above all, do not confuse familiarity with safety. The dollar system is familiar. The Treasury market is familiar. Dollar-based oil trade is familiar, but familiar systems can change. The people who get hurt in transitions are usually the people who never imagined the transition was possible. The people who benefit are the ones who see the cracks early, think in probabilities, and position gradually before the crowd is forced to react. That is where we are now. The petrodollar is not dead, but it is no longer unquestioned. The dollar is not disappearing, but its monopoly premium is being challenged. Gold is not a miracle asset, but it is responding to a real structural shift. And the investor who understands the difference between collapse and erosion, between panic and positioning, between a headline and a flow, has a major advantage. That is the point I want you to take from this. The real story is not that one country left an organization or one payment was made in another currency. The real story is that the old machine depended on automatic behavior, and the behavior is becoming less automatic. Oil sellers are exploring alternatives. Oil buyers are encouraging alternatives. Central banks are holding more gold. Some reserve managers are holding fewer treasuries. The world is moving from trust to verification, from concentration to diversification, from one dominant rail to multiple rails. That is a very big change, and big changes create risk for those who ignore them and opportunity for those who understand them. The next decade may reward investors who can think beyond the old dollar-centered map. It may reward those who understand energy, real assets, gold, commodities, and the flow of institutional capital. It may punish those who hold cash without understanding debasement, who hold bonds without understanding real yields, and who hold country portfolios without understanding global change. I do not know the future perfectly. No one does. But I know how to watch a system. And this system is telling us something. The petrodollar machine made the United States extraordinarily powerful. Now the machine is developing cracks. When machines develop cracks, you do not panic. You inspect the structure. You understand the pressure points. You reduce fragility. You build optionality, and you position yourself so that if the old structure weakens further, you are not surprised by the consequences. That is how I would think about the dollar. That is how I would think about gold. And that is how I would think about the opportunity in front of investors right now. The world does not have to end for your portfolio to need adjustment. The dollar does not have to collapse for gold to matter. Oil does not have to stop trading in dollars completely for the petrodollar system to lose some of its power. Small changes at the margin can create large consequences in a leveraged global system. That is the lesson. And once you see it, you cannot unsee it. The question is not whether you can predict every move perfectly. The question is whether you can recognize the direction of the flow before most people are forced to admit it exists, because by then, the easy money is usually gone.